Good morning and welcome back to Morning Trade Live. We are live on the floor of the New York Stock Exchange, moments away from the opening bell, trying to give you insight into the big picture of trading. And we've had some volatility and some pressure. Liz Ann Sonders is with us, Chief Investment Strategist Charles Schwab. It's great to see you this morning, Liz Ann. I'm so glad you're here. We have many topics to cover, and I will start with tariffs, retailers. We've had some developments even today with the EU and getting closer there, seeing some things on paper, but the retailers have been somewhat mixed. What are your thoughts?
They have been mixed. You get a story out of Home Depot where they had sort of patted themselves on the back a few months ago, saying that they would be able to keep prices contained. And that was probably because of some inventory build that they had, but that has kind of turned in the last few months, and they're now talking about some upward pressure on prices that they'll pass on to the consumer. Walmart, a little bit different a story today. It was the first miss in 3 years. Now they're saying that it was a lot of charges that were unrelated to things like tariffs, and they did raise guidance, but I think that there's now the wattage has been turned up on the spotlight on tariffs, the impact on retailers, turned up even to a more significant degree by virtue of the data we got out last week in the PPI, because the trade services component of PPI essentially measures margins. And that's where the big upside surprise was, suggesting we are starting to see some pass through to the consumer.
And it's interesting because, as I said, mixed, I think of names like TJX, and also we had Lowe's, and those beat the street, right? But we are going to likely see some of those tariffs passed on to the consumer, as we started to hear from the likes of Home Depot. When it comes to the big picture of the market, and we've hit some recent highs, however, you are seeing some sector rotation. You talked about the names that were under pressure in July and the performance of how some of those names are doing in August. Talk about some of the rotation you're seeing.
Sure. If you look at month to date, you see just a complete reversal of what happened in the first 7 months of the year, with a sector like healthcare performing well, it being the, I think, second to worst performer in the first 7 months of the year. You see it at the factor level too. Some of the higher quality, slightly more defensive factors like low volatility and dividend yield doing well, value-oriented factors doing well. They were the laggards in the first 7 months of the year. So I think there was a little bit of just an exhaustion rotation trade that kicked in. There may have been some fundamental concerns. Valuation certainly is always top among them as it relates to some of the prior high flyers in tech communication services, the Magnificent Seven, and then you add the recent report out of MIT, yet again questioning whether the spend in AI has been beyond, and maybe there's a bit more hype than what the reality is that we're facing in the numbers. So I think it's a confluence of things that caused this rotation. It's not all bad news. In the last year, only 20% of the S&P 500's constituents have outperformed the index. But over the past 5 months, which essentially represents the period since the early April turnaround day in the market, you've got more than 40% of constituents have outperformed. That's not a high number in an absolute sense, but well improved relative to the 1-year look back.
So it is showing some broadening out in the market, and maybe going back to some of those names people have longed for and trusted for many years, value plays, dividend payers, things that have worked over the decades. AI came on in full force. We talked about AI. We talked about trickling out from AI, the AI arms race, ways to make money and monetization of AI. And, we always say, what inning are we in AI? Or maybe even, is there too much AI hype? I don't know. We've seen a little bit of tech weakness lately. Could you expand on that?
Yeah, so I think we're still probably in the early innings from an AI perspective, spend and otherwise. You look at the capex data more broadly in the economy, and it is bifurcated between pretty subdued capex and capex intentions in more traditional areas, where it's still relatively full steam ahead on the AI side of things. I do think what we're focused more on, say, this year versus last year, not that the world or things like earnings and focus by investors operates perfectly with calendar years, but to use that reference point, the shift has been toward or away from just a total focus on the creators of AI, if you want to call it that, the infrastructure, the picks and shovels, to the utilizers of AI. So there's a broader focus right now, and more questions, specific questions being asked of companies. How are you using this in your business? Is it representing a cost savings? Is it a boost to productivity? So I think the conversation is broader, not to mention a focus more on the broader infrastructure of AI, inclusive of data centers. So regardless of whether it's still in relatively early innings, doesn't mean you don't have to go through pauses when you get to either a period of sentiment froth or concerns about valuation. That's certainly what we saw in the mid-February to early April period of time, when we had the near bear market in the S&P and actual bear market in the NASDAQ. Though many of those stocks were the ones that really took it on the chin, but memories tend to be short.
Yeah, and you make a great point, because we started to talk about soft landing, hard landing, recession, depression, stagflation. We've talked about all these different things pertaining to the Fed, but we did see some pullbacks, and as you noted, in tech in particular, a bear market. And now Jay Powell, who he's been under the microscope from the time he pushed the transitory language about inflation, when in fact it was not transitory years ago. And now, their reputation is on the line. They've been doing the best to try and take in the data and make some decisions. What do you think we may or may not hear from Jackson Hole tomorrow from Powell's speech?
I'd be surprised if you heard anything that was explicitly around what the Fed may or may not do in September. The purpose of the Jackson Hole meeting is around the process of the Fed, particularly the average inflation targeting component of that. And I think he'll try to keep those comments, particularly given that they're scripted, focused there. That doesn't mean there won't continue to be chatter on the Fed, what they'll do in September. Political influence on the Fed, which is top of mind for many investors right now. I think what really holds the key to what the Fed does in September, how much, and then what the path looks like from there. I think the key is held by the labor market. That doesn't mean they're ignoring the inflation data. And the minutes out this week showed that, at least as of the July FOMC meeting, the focus was more on inflation. That was seen as the bigger risk, but that was in advance of the July labor market report. I think if you were to do the minutes inside their own heads right now, given the data we have, my guess is that the bias might be a little bit more even, but I do think the next batch of labor market reports, which includes today's claims numbers, which were up, both initial claims, the 4-week average is up, continuing claims are at a cycle high. I think the next jobs report is probably going to be the bigger needle mover for probabilities around the September Fed meeting. Right now, I think 25 basis points is probably the best guess, but that could move.
And months ago, labor was the focus, right? Prior to, we've seen that changing for the Federal Open Market Committee. There was a time not that long ago that labor was the focus, and then inflation became the focus, and now we're back to labor. And to your point,
and labor was the focus last fall, when the Fed cut by 50 basis points, then did another 225s. But the bond market sent a very different message about maybe the Fed becoming too aggressive on the downside, given what were just concerns about weakness in the labor market, not actually acute weakness in the labor market. We have to remind people who think all the Fed has to do is cut and you get mortgage rates down and long-term yields down. In the period that the Fed cut the Fed funds rate by 100 basis points, the 10-year yield went up by 100 basis points. 30-year mortgage rate went up by almost 100 basis points. So we have to keep that in mind when we think about Fed policy. The Fed controls the Fed funds rate. They don't directly, or maybe not even indirectly, control longer-term yields, which is what borrowing rates are set off of in the real world.
Yeah, great perspective. Liz Ann Sonders, nice to see you. Chief Investment Strategist at Charles Schwab. Thank you, Liz Ann.